Hi folks, this is Doc Severson for the Theo Night Report for Thursday, December 15th. Looking around the markets tonight, starting with the S&P, we have the usual signals here. We're just consolidating after another big run. And I'll get to why that's important here in just a minute. So that's the S&P. Again, another big rally up here, holding underneath the 2300 level. Let's look over at the Dow Jones Industrials just for a second here. And again, as expected, kind of in a holding pattern right under 20,000 after another big run. Amazing run, actually. And then finally, I'll get over to the small caps over here, the Russell 2000. And the Russell has gone through a 20% rally over the last few weeks here and is in the process of consolidating yet again after another leg up. So where does that leave us as we get into 2017? How are we going to trade this market? This can't continue to do this indefinitely, right? So what are we going to expect to see from the market going forward, and how are we going to trade that? Well, let's go back to the S&P and zoom out for a second. First of all, there are different types of character that we see in the markets. So for example, you're not going to see these if you only look at the daily chart. This is what most people do, just look at the daily chart and then wonder why the market all of a sudden starts to break into more volatility or bigger range trading. Well, it's because of what's going on at the monthly and the weekly charts as well too. You can view these as sort of parent time frames to the daily chart. So right now what we've seen in the monthly chart is for about the last couple of years, we've been in a range. We've been trading in a range, and this is really no different than what we saw back here in 2011, right? Or even some periods during 2010, is that range expansion like this leads to range contraction, expansion leads to contraction, expansion leads to contraction, and we're just going through the next expansion phase to the upside. Now, a lot of people are putting weight and merit on that breakout, saying this can't happen, this can't be, there's no way, all the quantitative easing and printing and everything like that. Folks, it doesn't really matter. The price is the ultimate arbiter here, and it's telling us that right now the value is to the upside. Now this is not always going to stay like this, right? So markets when they go from periods of range expansion like this is typically called quiet and trending behavior here. And you can see a little bit more detail on this in the weekly chart, where we have generally a persistent trend that goes between periods of range expansion, range contraction here, range expansion to range contraction, range expansion, range contraction. We just keep going through this stair-stepping mode until it did indeed go into a larger corrective pattern here, which was really the end of 2014 through really the Brexit, around the June timeframe here in 2016. And since that time, we've gone right back into quiet and trending. So believe it or not, this is quiet and trending price behavior, much like what we saw in 2013. What's going to work with price action like this? Well, on the micro basis, if we go out to the daily chart, we can see that we're going to see these rallies that consolidate, rallies that consolidate, rallies that consolidate again. And so if you think about this, there's ways that we'll be able to take advantage of this through breakout trades, whether it's to the upside, or we could see breakout to the downside, but that's going to tie into the larger time frame charts. But breakouts to the upside, right? And what we can do is use expected move trades with a great reward to risk. So this is where we're setting up something that's maybe costing us on the order of $20 per contract to set up this trade. And we can realistically look to perhaps score something as high as $80 or $100 per contract on something like that. So we can use expected move butterflies. We can use expected move debit spreads at the known target. And then when we anticipate the consolidation, we can use something like a calendar spread, diagonals, or any other time spread. Now, the tendency is to use iron condors here, but unless we're going to use a very short-term iron condor that's set up with very short expiration on it, then we're better off using something like this, like a time spread, which is going to have the options at the money and is going to offer us the very fastest time decay. Now, eventually, after this stair-stepping goes on for a while, what we're going to run into is we're going to run into something similar to what we saw here in 2013, right? We have trend exhaustion down here. Now, what occurs after the trend exhaustion is we see more volatility come into play. Now, this actually scares people to death when this occurs because these are the first red candles that they've seen in some time, right? Imagine if we actually had a red candle that showed up that was more than 20 points to the downside. Oh, you'd see a lot of hand wringing, right? You'd see people overreact to that, but this is all very normal. So these are just the larger time frame exhaustion points, and this is where we're going to anticipate some larger movement within here. We're going to see higher realized volatility within this. Now, these are the times when we can actually go back to the old standby, which is out of the money credit spreads. So here we can actually set up the high probability iron condors. We can set up just single-sided vertical spreads if we want to. We can also anticipate the movement to the downside and set up some targets out of the money down here like this. Now, eventually, we will see this rally come to an end, and what will occur will be something very similar to what we saw at the end of 2014. As we get the monthly chart into exhaustion, which is a long way from happening at this point, so we still have several hundred points to go, at least the potential exists for that. Not necessarily saying it's going to get there, but the potential is there for this. But when this chart is ready to start working on corrective action, what we're going to see is much higher volatility than what we've seen right now. So we just came out of a high volatility range in here, and it's unlikely that we're going to go right back into one at this point. But when this is ready to go, we're going to start to see things like what we saw in October 2014, August of 2015, January of 2016, all of these highly volatile moves and mostly downside price action that we're going to see from there. Well, actually, it's two-way tape. For every action, there's an equal and opposite reaction to this. So we're going to get into a much larger range of consolidation when that does occur, wherever that does occur. And so we'll get plenty of warning before that actually does happen. Now, those are the times when the out-of-the-money, high-probability credit spreads are really great for that if we have the right timing for them, right? If we're patient enough to let the trade play out and really use that spike in implied volatility to our advantage, those will be in play, just like they were back here in 2015 and 2016. Those were great, right? But right now, this is suicide, setting up bear call spreads or out-of-the-money call credit spreads in the face of this trend, right? We want to go with the trend and not try to fight it. And especially with today's low implied volatility, we need to be net buyers of options right now and not be afraid of that instead of being net sellers. We can be net sellers when we have enough of a spike to the downside, when we have that exhaustion down here, then we can be net sellers temporarily. But these are just going to be short-term consolidations that show up, I believe, in the near future. But until that point, we're going to embrace what the market gives us, and those are going to be those expected move, breakout trades, and short-term consolidations through time spreads. That's what is going to be working for the short term. That is it for today's report. Thanks for listening, folks. Have yourself a great evening, and we'll see you tomorrow.